Let's take a look at UiPath for us, George. This is an interesting one that also is in the AI theme, as they're trying to replace basically, I think, coders, essentially.
Yeah, that's one part of their business. Essentially, it's a software business that's trying to automate the software development business, but also the end automation usage of integrating artificial intelligence to the end automation of services. And of course, robotics is embedded in their software is embedded in robotics operations. So, very interesting technology. I'll give them that. But if you look at the secular growth that's actually going on behind the scenes with this company, there's a couple things going on. It's, one would say maybe it's a hidden gem, but at the same time, they've lacked consistent execution with the stock over the last 3 years down about 66%. But competition, I think, is another thing, because one of the things I discovered while looking into UiPath is Microsoft actually has a power automation software that competes directly with them. So, for what it's worth, they're facing some challenges from, of course, large behemoths like Microsoft. But nonetheless, if you look at the report, it was actually pretty good on a comparative basis. They printed an 11-cent adjusted profit. The estimate was 7 cents, so they bested the estimated number by 4 cents, but still down relative to 12 cents adjusted last year. Sales did come in ahead of estimates at 354.7 million versus 347.6, so that was higher by about 8.8% compared to 325 million last year. And so, if you look at their net dollar retention rate, it was higher by 113%. So that's a good sign. You're getting the existing customer base to actually spend more. That gives you an idea there's a lot of traction, and customers find value in their products, their core products, and of course, additional service provisions and bolt-on products on top of it. I haven't looked at any guidance if they've updated it just yet. It looks like it's still coming out. But looking at the price action, obviously it's higher. One of the things I noticed about this particular business is, if you look at this quarter, I mean, first off, they just reported a net loss of $10.7 million. And it's a small loss, but nonetheless, if you look at the trailing 4 quarters, net losses in cumulative sum were 110 million. So at the current run rate, it's 40 million, which is better. So that's what I'm trying to say here. At the same time, over the past 3 quarters, if you want to include, of course, March, which started in April when they reported, they've been buying back shares. So one would say that maybe the buyback of shares demonstrates that they don't have a lot growth going for them when it comes to their core platform and services. But at the same time, it also might demonstrate they're very confident in their future.
All right. Yeah, I think that's a good way to put it. Confidence in the secular trend that's going to be supportive of them, but asking for a bit of a leap of faith from the market on their profitability side is sort of the trade-off you get from that right now. Thanks, George. Good analysis.